Stocks are shares in the ownership of a company. When you buy a stock, you become a part owner of that company. This means you have a claim on part of the company's assets and earnings. Stocks are also known as equities. Owning stocks can be a way to grow your money over time. If the company does well, the value of your stocks can go up. This allows you to sell them for a profit. However, if the company does poorly, the value of your stocks can go down. This means you could lose money. There are two main types of stocks, common and preferred. Common stockholders can vote at shareholder meetings and receive dividends. Preferred stockholders receive dividends before common stockholders and have a higher claim on assets if the company goes bankrupt. Investing in stocks can be rewarding, but it also comes with risks. It's important to understand these risks before you start investing. Let's dive deeper into how the stock market operates and functions. The stock market is where stocks are bought and sold. It operates through networks of exchanges. The most well-known exchanges are the New York Stock Exchange, or NYSE, and the NASDAQ. These exchanges provide a platform for buyers and sellers to trade stocks. When you buy or sell a stock, you do so on the secondary market. This means you're not buying the stock directly from the company, but from another investor. The price of a stock is determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. Stock prices can change quickly. They're influenced by various factors, which we will discuss later. It's important to keep an eye on the stock market if you're investing. This will help you make informed decisions about buying and selling stocks. Trading stocks can be done through a broker. Brokers act as intermediaries between buyers and sellers. They help facilitate the transaction and charge a fee for their services. Now let's move on to understanding stock quotes. A stock quote provides key information about a stock, which is essential for anyone looking to invest in the stock market. It includes the ticker symbol, current price, and daily price change. These elements are crucial for understanding the stock's current standing and performance. The ticker symbol is a unique series of letters assigned to a stock. This symbol is used to identify the stock on exchanges and trading platforms. For example, Apple Inc. has the ticker symbol AAPL. This symbol is recognized globally and is synonymous with Apple's brand. The current price is the last price at which the stock was traded. It reflects the most recent transaction and is updated in real time during trading hours. It gives you an idea of how much it will cost to buy or sell the stock at that moment. This price can fluctuate throughout the day based on market activity. The daily price change shows how much the stock's price has increased or decreased compared to the previous day's closing price. This change is often expressed in both dollar amount and percentage. Let's look at an example to better understand these concepts. Suppose Apple's stock quote shows AAPL at $150, up $2. This indicates a positive movement in the stock's price. This means the current price of Apple stock is $150 and it has gone up by $2 compared to the previous day. Such information is vital for tracking stock performance. This information helps investors make decisions about buying or selling the stock. By analyzing these details, investors can gauge market sentiment and potential future movements. Stock quotes may also include additional information such as the 52-week high and low. This data provides a broader perspective on the stock's performance over a longer period. This shows the highest and lowest prices the stock has traded at during the past year. It helps investors understand the stock's volatility and long-term trends. Other details might include the volume of shares traded, which indicates how actively the stock is being bought and sold. High trading volume can signify strong interest in the stock. Understanding stock quotes is essential for making informed investment decisions. It allows investors to make strategic choices based on real-time data. It helps you track the performance of your stocks and the overall market. By keeping an eye on stock quotes, you can stay informed about market trends and adjust your investment strategy accordingly. Next, let's explore the factors that influence stock prices. These factors can range from company performance to broader economic indicators, and understanding them is key to successful investing. Section 4. Factors influencing stock prices. Several factors can influence the price of a stock. One of the main factors is company performance. This includes the company's revenue, profit margins, and overall financial health. Investors closely monitor quarterly earnings reports and other financial statements to gauge how well a company is performing. If a company is doing well and making profits, its stock price is likely to go up. This is because investors see the company as a good investment with potential for future growth. Conversely, if a company is struggling financially, its stock price may go down. Poor financial performance can lead to a loss of investor confidence, causing them to sell their shares. Economic indicators also play a significant role in determining stock prices. These indicators include things like interest rates, inflation, and unemployment rates. For instance, lower interest rates can make borrowing cheaper for companies, potentially boosting their profits and stock prices. On the other hand, high inflation can erode purchasing power and negatively impact company earnings. Positive economic indicators can boost investor confidence and drive stock prices up. When the economy is doing well, consumers spend more and businesses thrive, leading to higher stock prices. Negative indicators, such as rising unemployment or increasing inflation, can have the opposite effect, causing stock prices to fall as investors become wary of future economic conditions. Market sentiment is another crucial factor. This refers to the overall attitude of investors towards the market. Market sentiment can be influenced by news, trends, and even social media. If investors are optimistic about the future, they are more likely to buy stocks, driving prices up. If they are pessimistic, they may sell stocks, causing prices to fall. If investors are optimistic about the future, they are more likely to buy stocks, driving prices up. This optimism can be fueled by positive news, strong economic data, or favorable market trends. Conversely, if they are pessimistic, they may sell stocks, causing prices to fall. Negative news, poor economic data, or adverse market trends can contribute to this pessimism. Global events can also impact stock prices. Events like natural disasters, political instability, and changes in government policies can affect investor confidence. For example, political instability in a country can lead to uncertainty about the future, causing investors to pull out their investments, leading to a drop in stock prices. For example, a natural disaster in a major manufacturing region can disrupt supply chains, affecting stock prices. This disruption can lead to delays in production and delivery, impacting company revenues and consequently their stock prices. Investors may react to these disruptions by selling off stocks, leading to a decline in prices. Understanding these factors can help you make better investment decisions. It's important to stay informed about company performance, economic indicators, market sentiment, and global events. By keeping an eye on these factors, you can better predict market movements and make more informed investment choices. In the next section, we will discuss how to get started with investing. We will cover basic investment strategies, how to choose stocks, and tips for building a diversified portfolio. Stay tuned to learn more about making your first investment and growing your wealth over time. Section 5. Getting started with investing. To start investing in stocks, you need a brokerage account. A brokerage account is an account you open with a brokerage firm. This account acts as a bridge between you and the stock market, allowing you to buy and sell stocks, bonds, mutual funds, and other securities. The firm helps you buy and sell stocks. There are many brokerage firms to choose from, so it's important to do your research and select one that meets your needs. Consider factors such as fees, the range of services offered, and the ease of use of their trading platform. Some firms offer educational resources and tools that can be very helpful for beginners. Before you start investing, it's important to do your research. This means understanding the companies you're investing in and their financial health. Look at their earnings reports, financial statements, and any news that could impact their performance. Additionally, consider the industry trends and the overall economic environment, as these can also influence a company's stock price. This will help you make informed decisions about which stocks to buy. Diversification is also key to successful investing. This means spreading your investments across different stocks and sectors. If one stock or sector performs poorly, your other investments can help offset the losses. Diversification can be achieved by investing in different industries, geographical regions, and asset classes. Diversification can help reduce risk and improve your chances of earning a positive return. It's also important to set investment goals. Decide how much money you want to invest and what you hope to achieve. Are you looking for short-term gains or long-term growth? Setting clear goals will help you stay focused and disciplined in your investment journey. Your goals will help guide your investment decisions. Now let's move on to some practical tips for new investors. Start by investing small amounts of money that you can afford to lose. This will help you get comfortable with the process without taking on too much risk. Also, consider using dollar-cost averaging, which involves investing a fixed amount of money at regular intervals regardless of the stock price. This strategy can help reduce the impact of market volatility on your investments. Section 6. Practical tips for new investors. When you're starting out, it's a good idea to begin with an affordable amount. This means investing money that you can afford to lose. The stock market can be volatile, and there's always a risk of losing money. Start small and gradually increase your investments as you gain more experience. Think long-term when investing in stocks. The stock market can be unpredictable in the short term, but it has historically provided good returns over the long term. Avoid making decisions based on short-term market fluctuations. Instead, focus on the long-term potential of your investments. Staying informed is crucial for successful investing. Keep up with news about the companies you have invested in and the overall market. This will help you make informed decisions about when to buy or sell stocks. There are many resources available, including financial news websites and investment blogs. Avoid making emotional decisions when investing. It's easy to get caught up in the excitement of a rising stock or the fear of a falling one. However, making decisions based on emotions can lead to poor investment choices. Stick to your investment plan and make decisions based on research and analysis. Section 7. Conclusion. In this guide, we have covered the basics of the stock market. We started with an introduction to stocks and their importance as a form of ownership in a company. Then we explored how the stock market operates, including the role of major exchanges like the NYSE and NASDAQ. We also discussed how to read stock quotes and understand the information they provide. This includes the ticker symbol, current price, and daily price change. We then examined the factors that influence stock prices, such as company performance, economic indicators, market sentiment, and global events. Getting started with investing requires opening a brokerage account, conducting thorough research, and diversifying your investments. Practical tips for new investors include starting with an affordable amount, thinking long-term, staying informed, and avoiding emotional decisions. Now that you have a good understanding of the stock market, it's time to take the next step. Start your investment journey with confidence. Remember, investing is a long-term commitment that requires patience and discipline. Subscribe to our newsletter for more tips and updates. Like and comment to share your thoughts and experiences. Happy investing!